Hi, good morning, everyone. We are going to start the webinar now. It's 11:15. So today we are going to present on a company initiation on Namely Press Metal, which we initiated 2 Fridays ago. This is our disclaimer. Please read it. Okay, I'm Richard, and I'm presenting today. The title of our report was Deeply Undervalued You Play. We had initiated a buy rating, target price of 69 cents, and the last close on Friday was 39.5 cents. 52-week range for Namly was 26 cents to 42 cents, and it has a market cap of 95.3 million. This is a chart showing the price over the last 12 months. Investment highlights for Namly. Firstly, it's undervalued and priced cheaply relative to peers. The price to book at the point of initiation was 0.7 times, and the forward PE was 6.9 times. This is in contrast to the peer average of 1.1 times PB and 13.1 times PE. It's not quite a NANEX stock, but its NCAV will be a floor. NCAV is a net current asset value, which is defined as current assets less the total liabilities. So you see here current assets minus total liabilities, and it's equal to 36.2 cents. Lower revenue year to date, but gross margin expansion has driven earnings growth. So for the first 9 months of FY16, revenue was actually 14.7% lower year on year, but PATMI was higher by 14.6% year on year. As I said, this is because of the gross margin expansion. But 3Q was weak, and so we're actually also forecasting a weaker full year for FY16 with a lower PATMI compared to FY15. Okay, yeah, it's this bullet point here, forecasted lower full year revenue and PATMI, but this is mitigated by the better gross profit margin. The other thing is the cash hoard is set to grow this year, potentially increasing the cash balance by about 30%. This is because of three factors: higher profit compared to historical level, better working capital management this year, and lower capex requirements this year. Namely also, we believe, has the ability to maintain and even increase dividends. In the last FY15, they declared 2.5 cents dividend. In terms of actual cash, this is $6 million. And if you compare with their net cash flow from operations, that is already in the mid-teens range. So they have adequate cash flow to support and maintain the existing 2.5 cents dividend, and there's the ability to increase it even. This is not a growth stock, but a yield stock. In our forecast, we are not forecasting PATMI growth. In fact, if you look at the report, the forecasted statements, the PATMI is actually flat or even down. But we say that this is a yield stock because of the dividend paying ability of the stock. For FY16, which is the current FY, we are forecasting 3.5 cents, which is higher than last year's 2.5 cents. This 3.5 cents implies a forward yield of 9.5% based on the initiation price at 37 cents. Okay, so this is the investment thesis. There'll be 4 slides here, and this is probably the 4 most important slides. So we say that this is a high yield stock that offers a compelling risk to reward proposition. Firstly, the re-rating catalyst. So it renewed its contract with major customer on better terms. This was done for 5 years. the new contract will be for 5 years. Their contract is always for 5 years, and I'll go into more details about this major customer in one of the later slides. We believe that this contract had expired around the end of 2013, and so they renewed the contract sometime in the first half of 2014. So for normally their fiscal year end is in September. So if you think about the first half of 2014, that would actually be second quarter and third quarter of FY14. So you can see that 3Q14 gross profit margin has been improving for them. This coincides with the time when they renegotiated their contract. Also, you can see that gross profit margin is quite volatile quarter on quarter. So, okay, I've mentioned gross profit margin not stable quarter on quarter due to project-based products. So, apart from their major customer, Namli also has a lot of project-based products, and this would contribute to the lumpiness in terms of revenue recognition and profit. We are forecasting on a full year basis gross profit margin to be sustainable at low 20s and at worst high teens level. Notice their gross profit margin over the last 5 years. As I mentioned, the improvement in gross profit margin started in second or third quarter of 2014, and the full year effect was seen in 2015. That's why FY 2015. So you can see that this vast improvement in gross profit margin here. Okay, so about their major contract with their customer. This contract is deals with them supplying aluminium plates, aluminium frames that are used in refrigerated containers. So these refrigerated containers are also known as reefers. Demand for reefers is non-cyclical because they are used to transport perishable food, and demand is driven by population growth and desire for fresh food. Main trade routes of movement of the reefers is you can see bananas and pineapples out of Latin America, meat and dairy shipped out of Australasia, and intra-Asia movement of seafood, dragon fruit, and other fruits. As mentioned earlier, there's also the project-based revenue. This comes from construction. So construction demand is expected to remain stable with slight upward trend. They participate in both public and private sector projects. According to the BCA, there's a steady pipeline of projects all the way to 2020. This table shows 2015 value of contracts, and this is a forecast for 2016, and following that is forecast for next 2 years and the next 2 years. So you can see it's expected to be stable with some slight upward trend. So at the point of initiation, it was just hovering close to its NCAV, which was I mentioned 36.2 cents. This will serve as a price floor. This is a method of putting a liquidation value on the company, and it conservatively assumes that non-current assets do not have any salvage value. So we are using only the current assets and less all the total liabilities, and this is more conservative than looking at the net asset value. So as mentioned, is NCAV is 36.2 cents, and any discount to it is irrational. We think that there has been an overhang in share price due to customer concentration risk of this one major contract. Is valid but overblown in our view. they normally has a long partnership with this customer, which is a carrier, and they derive their economic mode from the high switching cost that the customer would experience. So next bullet point, new elevated level of earnings and growing cash hoard raises possibility of higher dividends. So we're expecting low double-digit PATMI and lower capex, and this would lead to growth in cash on the balance sheet. Okay, this is a bit more. This section is a bit more dry. We're going to talk about the company background. So Namli has three business segments. Aluminium is the largest of all. The three segments are aluminium, mild steel, and stainless steel. You can see this is historical FY15 revenue and profit before tax for aluminium, mild steel, stainless steel. Again here, aluminium, mild steel, stainless steel. And from this you can see aluminium is getting the best margins, and probably just focus on the aluminium part of business and not to bother about the steel part. Okay, so it says here, a significant contributor to aluminium segment is the contract with its major customer. So the major customer is Carrier Refrigeration, and normally provides the aluminium frames used in the refrigerated containers, which are also known as reefers. Also mentioned, as I mentioned earlier, also they derive sales from manufacturing and building products as well. The building products are the ones that contribute some volatility in their revenue recognition. This could be timing issues on their billing and project completion timeline as well. So these are the things which would make the revenue recognition and PATMI volatile quarter on quarter and maybe even year on year basis. Okay, so this is just to show their key specialty product, which is the aluminium frame. This is what they produce at Namli. All these are the aluminium frames, and it goes on to the end of the container truck where the refrigeration unit is mounted here. So you can see this is exactly the same. It's the same component here and here. Yeah, this one of the product from the mild steel segment is a gate. And this is a stainless steel product from their other segment. So these are the stainless steel railings that they have as well. Okay, so they also, as I mentioned, they have they do buildings and these projects. So they also have a track record of delivering on public and private projects which are used for residential, industrial, and commercial use. So this is just a photograph of their past project. This is an industrial building. On the right is a commercial building where they supply the cladding. Okay, and these two are residential projects. On the left is private residential, on the right is public residential. So they do participate in all kinds of projects for buildings. Okay, cost management strategy by shifting production outside of Singapore. So their headquarters is in Singapore, but they have 5 plants in Johor. They have made a conscious effort to shift their production capabilities outside of Singapore to Malaysia, where the costs are lower. So in first quarter 2014, originally they were located at Senoko Drive, but they have right-sized to Sungai Kadut. So if you look at their land area, you can see that they actually reduced it by about 40%. In the following year, they acquired their second site in Tempoi. So in total now they have 4 plants. In total they have 5 plants in Johor. So the other 4 are in these locations as well, and you can see based on their land area, they are significantly, the sum of it is significantly larger than their current one in Sungai Kadut in Singapore. So the one in Singapore mainly serves as the HQ and as well as the after sales support to their customers, and not so much on actual production of the products. Okay, Namly has remained profitable ever since its listing in 1999. So this shows their net income historically has been low single digit, and now it's going up to the low double digit. So you can see also is year on year is volatile, as mentioned several times already. This is because of the buildings products that they also supply. They have a clean balance sheet with low debt, and they are in a net cash position. Net cash of 39 million here versus their market capitalization of 95 million. So you can see almost half the market cap is net cash. Where this net cash comes from is actually the 43 million in cash and less the 4 million in term loans and finance lease liabilities. So net cash, the net cash position is equivalent to 16.2 cents per share. Current ratio and cash ratio are both more than 1, and their debt to equity ratio is low at 3.6%. So you can see here, this is the historical full year current ratio and cash ratio, and this is what's going on for the first 9 months of this current FY. So you can see both are actually trending up, and we are forecasting both current ratio and cash ratio to be at these levels for the next 2 years. Better cash flow generation in FY16. This is the due to inventory and receivables which are being pared down from the FY15 level, which is the start of FY16 actually. Historically, they have lumpy net cash generation from operations. Is due to the occasional build-up in inventories and receivables, but we think that FY16 cash flow will be better than FY15 because the inventory and receivables levels have slowly been converted to cash over the 9-month period, and also capex should be pared down going forward, as they are not as they didn't purchase any factory in Malaysia recently. Having said that, they do have capex requirements to buy machinery, but that should be less than their capex levels when they want to start the new factory. So for them, cash conversion cycle is quite slow. This is primarily due to their inventory holdings. So average cash conversion cycle is 161 days over the last 5 fiscal years. So it's the average of these 5 numbers here. And working capital is largely tied up in inventory for an average of 108 days. So it's the average of these 5 numbers here from FY11 to FY15. Take note that cash conversion cycle here is not the sum of these 3 numbers, it's actually the sum of the first 2, and then you subtract the last one. Namly also has a history of paying dividends. We are forecasting 3.5 cents total dividend for this FY and the next one. So for them, they declare their dividends once a year at the end of the year, and they have a dividend policy of paying about 1/3 of earnings. So this payout ratio is inclusive of special dividends. So if you look at this, actually in the last 5 FY, their dividend payout has actually been on an upward trend. Historically, they pay 1 cent dividend ordinary, and they have paid 0.5 to 1.5 cents special. So we are forecasting 3.5 cents total, which is 1 cent ordinary and 2.5 cents special. Okay, moving on to valuation. So we are using a blended method of P multiple and DDM, a dividend discount model. Um, so PE allows us to benchmark to the peer average, while um, DDM, the dividend discount model, will we use it in view of the cash generating ability of the business and its history of paying dividends. So first is the P multiple valuation. So we selected a set of global peers with some criteria. One criteria is this: they should have about the same market capitalization as Namli. We also only selected those that have been profitable and are producing aluminium or steel products which are used in housing or infrastructure projects. So you look here, this is a Namli, this is market cap in Singapore dollars, and this is the market cap of the peers as well. So we have narrowed them down to find peers of comparable market cap comparable market cap to Namli. This is just showing in their local currency of the various global peers and their price in the local currency as well. So we have conservatively assigned 10% discount to peer average PE. Peer average PE is actually 13.1 times here. With the 10% discount, we get 12.1 times PE, and our EPS forecast is 5.4 cents. This derives a valuation of 65.3 cents. One thing to note, if you look here, Namli's ROE and ROA is also higher than the peer average. Okay, for DDM, dividend discount model, we see that balance sheet remains strong for Namli and is in a net cash position, which very likely can be maintained. So we forecasted higher dividend of 3.5 cents. This is higher than the last FY of 2.5 cents. So we are calling for 3.5 cents for the next 2 years, and then 4.4 cents for the next 2 years, and then 4.5 cents thereafter. We have also conservatively assumed zero terminal growth rate for the DDM, and we derive a valuation of 72.4 cents, and the blended valuation, which is the average of the two, will be 69 cents. This implies 86% upside from the initiation price of 37 cents. Okay, so this is just to wrap up a bit. Investment merits for Namli. Firstly, there was a re-rating catalyst that will drive better margins. Second, non-cyclical demand for their core specialty product of aluminium frames. This is a key component to the container refrigeration units. There's a margin of safety for downside protection because there's an NCAV, and at the point of initiation it was just a 2.2% above the NCAV, which is one way of looking at it is a liquidation value for the company. So we've also talked about it being high yield, so it's not a growth stock, it's high yield stock, and it has low debt. So current debt to equity is only 3.6%, and if you're looking for yield, this would avoid the vagaries of interest rate movements as well, since the debt level is quite low and they are paying a high dividend yield as well. So if you assume 3.5 cents dividend, then that would translate to a very attractive forward dividend yield of 9.5%. Okay, so these are the risks. Namely doesn't disclose much information, so there's limited disclosure on their key contract, even the other parts of their business. So there's some risk in terms of information, and they are very reluctant to disclose details on things such as their contracts and their production capacity. The other thing is revenue recognition is lumpy, as I mentioned. Significant portion is from projects, so this also could lead to disappointment. apart from its major customer of the aluminium frames, the rest of the group's products are project-based and there's no order book, so there's not much visibility on revenue recognition as well. And revenue recognition could be volatile because of timing issues and project deliverable timeline. On project deliverable timeline, also losses may arise if projects are delayed. Delay in projects will drive up costs and in um, extreme situations could lead to losses on specific contracts. So in conclusion, our investment thesis for NAMI is a high-yield stock offering a compelling risk-to-reward proposition. The balance sheet is strong as well. So we have a recommendation to buy it. The target price 69 cents. Last close price 39.5 cents on Friday. Okay, so we have come to the end of the presentation. We'll pause now for questions, but one thing to highlight also is that the link to our archived webinars has been changed. This is, please take note here, it's right here, this is the new link where you can access the past webinars. You can refer to the PowerPoint presentation and you can watch the webinars again. So once again, take note that the address has changed for our archive. Okay, everybody, since there are no questions, then we shall end the webinar here. Do tune in again next week for our webinar. Thank you.